One of the great things about many option strategies is that they have a very high win rate, which is a confidence booster for traders as they expand their playbook of trades. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our desk are trained to understand how to apply high probability option strategies in unique ways that sometimes provide spectacular outcomes. In this video, we're going to be teaching you a strategy which can give you a really solid win in many cases, and in certain cases can produce an absolutely astounding return on your capital. So if that sounds interesting to you, then stick around because I think you're going to find this pretty fascinating. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Since the COVID-19 crash of March 2020, took place, the market has been on a tear for close to 2 years now, with all of the major indexes staging breathtaking rallies off of their COVID-19 crash lows. And I'd like to turn your attention to the Russell 2000 index, also known as the RUT index, which staged a 238% rally off of its pandemic lows by late October of this year. But as every trader knows, no matter how strong a rally is, there are also going to be pullback periods, often because the traders and investors want to take profits and lock in their wins, which creates some selling pressure periodically. Now, we're going to teach you today a strategy for how to play a rally that at the same time gives you a special kind of lottery ticket if the market pulls back at one point during the course of a rally, which I think you're going to find really interesting. But before we dig into the details of that strategy, I wanted to mention that if you're interested in learning 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money, whether the market goes up, down, or sideways, and how to make money on a stock or index trade, even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this. Pause this video right now, sign up, and resume watching. Okay, so now in order to teach you this strategy, we have to make sure you understand how index options work, because those are the kinds of options we'll be using in this example. Now, some of you may not fully understand how index options work, so we're going to do a really quick review of them. And those of you who are familiar with how they do work, just hang in there. This is going to be quick. The best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that that option expires. If the index does close above the price on expiration day, then the call buyer gets $100 per point that the market closes above the call strike price. A put option, on the other hand, is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of that put. So, for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is $4,000. But if the 40.75 call was owned, you would expire that worthless, as the index didn't close above 40.75. So the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below that put strike price of 40.75. But the 4,000 puts, those would expire worthless because the market didn't close below the 4,000 strike price. So now with that in mind, let's head back to October 27th. And as you can see, the RUT index was trading at 2288 on that day. And so suppose that we put together an options trade by moving out to an options chain that expires on November 26th, which is a month later, and we start by buying two of the 2290 puts, which are located basically at the same strike prices where the market's trading. And then we move down the options chain and sell four of the 2270 puts, and then move even further down the options chain and buy two of those 2220 puts. And when you enter this combination of short and long options in this formation, it's known as a broken wing butterfly to options traders. Now, to understand this trade, let's first break down the cash flow of the trade entry so you'll understand exactly what's going on. And so we'll start with the four puts we sold at 2270. And we got a price of $41.65 for those. But remember, we get paid $100 per point if the market drops below 2270 when those options expire. So you multiply that by 100, and we sold four of them. So that comes to a total of $16,660 that we received for those. But then we turn around and pay $49.95 for those two 2290 puts, as you can see, resulting in a cost to us of $9,990. And we also paid $52.20 for the 2220 puts, which actually results in cash inflow to the trader's account of $1,450. And your broker will require you to put up $4,450 to enter into this trade, which is also its worst case scenario. Okay, so let's move now forward to November 8th. And as you can see, the RUT index opened that morning at 2452. Now, let's say that on that morning, we decided to modify our trade in the following way, and that is to buy back two of the 2270 puts that we sold and buy those back for $5.45 each, and simultaneously sell both of the two 2220 puts that he bought when he entered the trade. Now, that would result in a trade that, when this modification is completed, looks like this, with the only thing left from the original trade being the two original 2290 puts we bought and two of the four original 2270 puts that we sold. Now, why exactly would we do this is the question. Well, let's take a look at the cash flow to start to explain the point of doing this. And so you remember, the original trade generated a cash inflow of $1,450. And so starting out with that, we then first look at the effect of buying back two of those 2270 puts, which cost us only $5.45 a piece because the market had rallied so much that those puts lost a lot of their value. And so to buy them back only cost us $1,090, as you can see. But we are also selling both of the 2220 puts for $3.50 each, resulting in proceeds from that of $700. And you would also note those lost quite a bit of value, but we're selling those. And so when you now recalculate the cash flow situation for the trade, you can see the cash flow, the positive cash flow has now dropped to $1,060. Now, what's important at this point is the fact that all of the risk has been taken out of the trade, and we'll show you why that's true in a minute. But I want you to stop and think about one thing, and that is that if on the day these remaining options expire, the RUT index is trading at any price greater than 2290, then both the 2290 options we own and the 2270 options we sold, both of those expire worthless. And the $1,060 we collected, we just pocket and we have no further obligation. So we'd make over $1,000 if that happened. But what happens if those options don't expire worthless and instead they expire with some value? That's where it gets interesting. Well, that's exactly, in fact, what happened a little later in the trade. And so let's move to the final trading day of these options. As you can see, the RUT had sold off to 2245.90 by the end of that final trading day, which means that both the 2290 puts that we own and the 2270 puts that we sold, both of those have value at that point. So since this is the last trading day of the options, this is the point at which these options get settled. And the one who sold us the 2290 puts will owe us money. And the ones we sold the 2270 puts to, we're going to owe them money. And you'll see all of that in a minute. So let's first focus on the two 2290 puts we own. Well, the RUT index closed well below 2290, so we subtract the 22.90 strike price of those puts from the 22.45.90 closing price. And we conclude that the 22.90 puts have expired $44.10 in the money. And so remember, we get $100 a point for both of them. So the total comes out to $8,820 of value from those puts. But don't forget, the index also closed below the 22.70 puts we sold. So those we owe money on. And as you can see from the calculation, we owe quite a bit on those, $24.10 in the money options to be exact. And so as you can see, we had to pay out $4,820 on those. And remember, we're still holding that cash flow after adjustment of $1,060. So when you add it all up, the entire result of the trade, as you can see, is a return of profit of $5,060, which is a 113% return on a trade in 30 days on the original $4,450 of required capital. Now, you might recall that I earlier mentioned that once we made that adjustment on November 8th, we took all the risk out of the trade. Now, why did I say that? Well, let's think about it. As we said, if the RUT had closed above 22.90, then we simply made the net cash flow after the adjustment, which was $1,060. But if the index closed between 22.70 and 22.90, then the 22.90 puts gained $100 a point below a RUT price of 22.90, but the 22.70 puts would expire worthless. But as soon as the RUT price gets below 22.70, then we start paying out $100 a point per put for every point below that, which means that the position can't gain any value after that, because while the 22.90 puts would be getting more and more valuable, the lower the index went, the 22.70 puts would be hurting us at the exact same rate as the 22.90 put is helping us. And so they cancel each other out below 22.70, which puts a cap on the potential profit of the trade. And so if you think about it, once we made that adjustment, there was no risk in the trade, because at any price, as we just proved to you, the trade made some money, specifically a minimum of $1,000.60 if the RUT closed above 22.90, and more profit, sometimes a lot more profit if the market closed below 22.90. And so that's why we said sometimes you can turn a nice win into a spectacular win, as was the case in this trade. So what I want you to take away from today's video is not so much that you can, in an ideal case like this, let's admit it, make over $5,000 in a month for a trade of this size when everything goes right, but rather that if you time things intelligently, you can put yourself into a no risk position on a trade with the potential for a spectacular win still on the table, because you pulled all the risk out of the trade, yet still left some significant potential profit to be made in the event of a retracement. And of course, sometimes you won't get this retracement, but so what? You still made that over $1,000 on the trade, which is over a 20% return in 30 days guaranteed. These are the kinds of opportunities that professional traders make all the time. And now that you have the knowledge, you can do the same. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now, so you won't miss all the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.